You are 25, your first real job. Your checking account finally stays above $2,000 at the end of the month. Rent is $1,300 for a modest apartment. Gas is $120. Groceries, $400. Your credit card balance floats around $800, but you pay it down before interest hits. Today, you set up an automatic transfer, $1,000 every month into a low-cost S&P 500 index fund inside a Roth IRA and a brokerage account. The app confirms it. Scheduled, recurring. The first 24 hours feels small, almost boring, but something shifts. That $1,000 is no longer available. It's not weekend money, not emergency sneakers, not a last-minute Vegas trip. Loss aversion kicks in immediately. Even though you chose this, it feels like something was taken. Your available cash drops. Your margin for error tightens. If your car needs a $600 repair tomorrow, you feel it. If your credit card due date overlaps with rent, you notice the timing more carefully. Systems start shaping you. Automatic clearinghouse transfers, settlement periods, IRS contribution limits. You check the market before bed. It's down 0.8%. Your $1,000 is now $992. The drop is irrationally painful. If this kind of tension feels real to you, hit like, subscribe, and turn on notifications, because the earlier you prepare your mind for financial uncertainty, the better you survive it. Level 2. 3 months in, you've invested $3,000. The account shows $3,140, then $2,980, then $3,220. Volatility is no longer theoretical. Your friends upgrade apartments. One finances a new SUV at 6.9% APR. The payment is $620 a month. You calculate quietly. That's more than half your investment contribution. Opportunity cost becomes visible. If you stopped investing for 1 year, that's $12,000 freed up. A nicer place, better furniture, more travel. But compounding whispers differently. At an average 8% annual return, that $12,000 could double roughly every 9 years. Skip 1 year now, and your 45-year-old self might lose over $25,000 in future value. Overconfidence creeps in during a bull run. Your account crosses $15,000 faster than expected. You start thinking you understand the market. You consider picking individual stocks, maybe tech, maybe leveraged ETFs. Fear cycles follow. A 12% correction wipes out months of gains. Your $18,000 drops to $15,800. You feel stupid for not locking in profits. Decision fatigue sets in. Keep buying? Pause? Wait for a bottom? Automatic investing keeps pulling $1,000 monthly. Discipline overrides emotion. For now, level 3. 5 years pass. You're 30. You've invested $60,000 total. Assuming average market growth, your portfolio hovers around $73,000 to $85,000 depending on timing. The numbers feel real now. Your lifestyle reflects trade-offs. You still drive a reliable used car. You declined a luxury apartment upgrade that would have added $700 a month to rent. That's $8,400 a year redirected into assets instead of square footage. Your credit score sits above 760 because you manage utilization carefully. Your 401k at work adds another layer. Employer match. Pre-tax contributions lowering your taxable income. You understand how the IRS rewards long-term behavior. Meanwhile, peers carry $12,000 in revolving credit card debt at 22% APR. That interest compounds against them. Your money compounds for you. Then a recession hits. Layoffs spread. Your company freezes bonuses. The S&P 500 drops 25%. Your $90,000 portfolio shrinks to $67,500. Panic becomes social. Group chats fill with fear. Some sell. Some stop contributions. You feel the urge to protect what's left. Loss aversion intensifies because the balance is bigger now, but you keep buying. Each $1,000 now purchases more shares. The discomfort is sharp. The math is colder. Level 4. 10 to 15 years in, systemic forces become obvious. Inflation averages 3%. What cost $1,300 in rent now costs $1,900. Groceries that were $400 are closer to $650. Your income rose, but so did expenses. You calculate real returns. If your portfolio earns 8% annually, but inflation eats 3%, your real return is about 5%. By year 15, you've contributed $180,000. With compounding, your balance may sit around $275,000 to $320,000 depending on market cycles. Now the math feels heavy. If you stopped investing, that $1,000 monthly redirected into a high-yield savings account at 4% would generate predictable but smaller growth. If markets average 8%, the opportunity cost over the next 10 years could exceed $100,000. Banks send credit card pre-approvals, $25,000 limits, travel rewards. Payment networks encourage spending. Merchants offer buy now, pay later. You recognize the behavioral trap. Easy credit increases lifestyle inflation. Lifestyle inflation reduces investable surplus. Reduced surplus disrupts compounding. You feel decision fatigue in subtler ways. Should you rebalance? Increase contributions to $1,200? Shift to bonds? Overplanning competes with simplicity. The system pressures you to consume. The math rewards you for restraint. Level 5. 20 years later, you are 245. You invested $1,000 a month for 240 months. Total contributions, $240,000. At an average 8% annual return compounded monthly, your portfolio could approach $590,000 to $650,000. In stronger markets, potentially more. In weaker cycles, less. But the $500,000 threshold is no longer abstract. You didn't become a billionaire. You didn't beat Wall Street. You built optionality. You can downshift careers, fund a child's education, increase retirement contributions aggressively. You understand that another 20 years of compounding without adding a single extra dollar could potentially double that balance again. The real transformation wasn't financial. It was behavioral. You learned to tolerate volatility, to override fear cycles, to resist overconfidence during bull markets, to see opportunity cost in everyday spending, to understand APR, inflation drag, and the IRS tax code as forces shaping your future. The macroeconomy moved. Recessions came and went. Interest rates spiked and fell. Payment systems evolved. Through all of it, your automatic $1,000 kept executing. The question now isn't whether this works. It's whether you could endure it. If you were 25 today, would you commit to $1,000 a month for 20 years? Or would lifestyle inflation win? Comment your strategy, your fears, or your survival plan. Because the difference between financial stress and financial leverage often begins with one disciplined transfer.